Hey everybody, this is Mitch Ferraro from F Street. I hope everyone's having an amazing day out there today. I am the investor relations manager here. I'm super excited. We got a lot of buzz going on in the office today. Reason being, we are going live with two industrial deals. I've got two of our development associates with us, Lane and Brian. I'm super excited to have them on because guess what? We're going to be telling you everything about these deals today and going to dive into a little bit of what they are, but also kind of talk about what are some of the terminologies of these deals and what they actually mean so that you as the investor can have a better understanding of what these look like. And if they work for you, possibly invest with us. So Brian, Lane, thank you so much for being on today. Really, really appreciate you guys. And just so you guys all know, these two are the reason why we're able to get these deals out to you because they are in these deals day in and day out to make sure that they are the right deals for you as an investor to come invest with us. So boys, thank you so much. I know you guys feel the energy, the excitement that's going on. I can tell it in your faces already. I mean, come on. Can I get a little excitement?
We're thrilled to be on here today, Mitch.
Okay.
And, I just want to back up a little bit. Great introduction, Mitch. I really appreciate that. But for everybody that's listening or watching this podcast, just to give you a frame of reference for the F Street office, right when you walk in, you see a row of 4 desks. 3 in a row. It goes Mitch, myself, and then Lane. And we are, jabbing all day. We are just getting after it. And now we're in here doing the same thing, but in the podcast studio. So thanks for having us today, Mitch.
Yeah, absolutely. Lane, anything you want to jab in there?
Yeah, I'm pretty tired right now just because I do sit next to you two all day, and it's exhausting.
No, it's not.
Thank you for having us on.
You love it. All right, so boys, we've got a couple of industrial deals, a couple of acquisitions that we are going live with. One in Prairie du Chien, Wisconsin, the other in Hot Springs, Arkansas. What I kind of just want to start out with is either you can just go at it right away, but let's start with Prairie du Chien. Let's just give a high-level overview to the investors of what that deal looks like, and you guys can go back and forth or however you want to do it. I can interject with questions, but let's give our investors a high-level overview of what that deal looks like and why it's a good deal.
Yeah, I can take that one first. Prairie du Chien is the simpler of the two deals, F Street, PDC, LLC. We are engaging in a 20-year sale leaseback absolute net lease with the seller and tenant of the building. An absolute net lease is slightly different than what you've heard in a triple net lease, likely. The main difference being that in a triple net lease, the tenant pays all of the taxes, insurance, operating expenses. They take care of all of that, but the landlord's on the hook for major things, capital repairs such as replacing the roof, replacing the parking lot, whatever it might be. Typically anything over $25,000 can be considered like a capital expenditure.
Yep.
In an absolute net lease, like we're engaging with the current seller of the building, is where the tenant takes care of absolutely everything. That's what helps me remember. Absolute net, absolutely everything is taken care of by the tenant.
Awesome. Yeah.
Yep. So we're engaging in a long lease with them. This is likely going to be a long-term hold. It's got really great cash flow out of the gate, over 9%. Which is kind of rare to find in these types of industrial deals. So we're really pumped about that. We jumped on the opportunity. But yeah, it's going to produce great cash flow. It's going to be a long-term hold. You're going to be able to get some depreciation against your passive income. Yep. And yeah, we're thrilled that we're launching this today.
Yeah. So basically absolute net lease. Great, because we're not responsible for anything.
Yep.
We're going to have cash flow right out of the gates. And then also at the K1 at the end of the year in 2025, we're going to have some sort of depreciation that you're going to be able to write off against your other passive income that you have coming in. So those are the major 3 selling points of Prairie du Chien.
I'm going to cut you off for just half a second here. In the case that the big, beautiful bill gets passed in the way that it is currently, not sure that it will. We're not saying that it will.
Yep.
There's a chance that we get back that 100% bonus depreciation. So you could even have bigger passive loss offsets to your K1 than you've had in the past couple of years with our deals.
That is something that with our cost segregation study and the firm that handles all of that, they've actually already ran both analyses with the current tax code and how that depreciation is going to flow in, what it is right now. And then also we'll call it that best big, beautiful case in case that bill gets passed. What does that, 100% bonus depreciation look like in terms of your investment? What is that going to look like on your K1 if that gets passed?
Yeah, and just so that you as investors know, what that kind of looks like, so when you receive a K1 and you show passive losses, let's say you have some other investments that create passive income. For example, if you have rental properties that are creating passive income, this K1's with the passive loss is going to help combat that income so you don't have to pay taxes on the full income that you're getting. So it's just the way that we do a lot of our industrial deals, so that we do the cost segregation studies. We forward accelerate depreciation to show those passive losses to help you, the investor, write off some of your other passive income. So again, absolute net lease. We've got the cash on cash right away. We're going to start distributions right away on that deal. Do you guys know when distributions might start on that deal yet?
Yeah, absolutely. So this deal is nice and easy. We don't have to prorate the rent or anything because we are closing on the last day of July.
Okay.
So we're actually acquiring the asset on July 31st.
Okay.
So for August, we'll have 1 full month of rent.
Yep.
And on the last business day of August, we'll be doing that first distribution.
Excellent. Excellent. So cash flow right away. And then again, the depreciation on the K1. So, all right. That's high level for the first industrial acquisition. Let's talk about Hot Springs, Arkansas. All right, so we got Big Beautiful Brian here. Big Beautiful Brian, tell us about Hot Springs, Arkansas. What's going on with that deal? Give us the overview. And kind of like what Lane did, he gave us like 3 really good spots of like why this deal is such a good deal. Give us an understanding, kind of like high level, what that looks like.
Yeah, absolutely. So a little different from Prairie du Chien. Hot Springs is more of what we would call a value add investment profile.
All right.
So Prairie du Chien is very stable, cash flows, 20-year lease term. Hot Springs, we have a lot shorter of a lease term. Now, we still have cash flow immediately. So we have about 8.5% cash flow right out the gates.
Okay.
And that goes through the first 22 months of the investment.
All right.
What happens after that 22nd month? Well, the main tenant in this investment is called Mountain Valley Water.
Yep.
They're a very large water company, and they have a lot of operations in Hot Springs, Arkansas. So their lease expires in the 22nd month of this investment.
Okay.
So sometime in May of 2027.
Yep.
Now, at this point, right now, their rent is below market value.
Sure.
So they're paying $375 per square foot triple net rent right now.
Yep.
We believe today the market is closer to $475 to $5 a square foot.
Okay.
So when their lease renewal comes, we have 2 options. We can say, hey, Mountain Valley Water, would you like to stay in this building and just pay a little bit more in rent?
Yep.
Or you guys can leave this building. We can find a new tenant and get the market rent of $5 a square foot triple net, or even in 2 years, it could be a little higher than that.
Sure.
I can tell you what, you don't want to play hardball with this guy over here,
Yeah,
Brian.
I can
Big
tell.
Beautiful Brian.
I can tell.
He's gonna get you to market
He's
rates.
going to punch you.
Lease
want
negotiation table, you don't want to be on the other side of it. No, but we were very fair to our tenants. But yeah, so if we can bring these rents to market, what we do then is we're going to refinance this asset because our net operating income is going to go from here to up, to the market level.
Yeah.
Which means our building is going to have a higher valuation.
Sure.
And at this point, that's when we can refinance, we can cash out and return a lot of equity back to our investors.
Yep.
So instead of paying them back a little bit of equity at a time, we give them one big chunk without selling the asset, and you can still cash flow after that.
Yep.
That's tax free as well because it's refinanced.
Yeah.
Exactly. So when you sell a property, you have to pay your capital gains taxes, any depreciation recapture.
Yep.
On a refinance, it's tax free. It's a normal distribution going to you as the investor. Yep. So that's one reason why, all things equal, if we can refinance or sell, all things equal, we're going to lean towards the refinance because we avoid that taxable event.
Yep.
And, we understand that a lot of our investors, they don't want to pay taxes.
Yep.
It's, one commonality between a lot of our investors is if there's a way to avoid taxes with depreciation or refinancing instead of selling, that's kind of their preference. And so in turn, that's our preference as a investor focused firm.
Yeah. Let's talk a little bit about just our general thesis on the industrial side. And this also is on our multifamily side as well, but we'll stick to industrial today. You're talking about recapitalizing and giving the money back to the investors. I think that's important for investors to know that if we execute on the 22-month plan, like we are talking about for Hot Springs, Arkansas, we are going to get you your full amount that you've invested into the deal back to you. And then it's going to be a split of cash flow. A lot of our deals do this where over a certain period of time, you're getting cash flow from us. And then at one point in time, we want to either refinance or sell the asset where you're getting all of your money back. And in this instance, if it's a refinance, you're getting all of your money back. And then we go into a split of cash flow for all the money that's coming in on that building through the rent. We're doing a split of cash flow. So let's talk to our investors, just high level general thesis of how do we do these types of deals in, getting their money back and then splitting the cash flow? Because essentially, once you get all your initial investment back, you're essentially getting infinite return on your money. You don't have any more money in the deal, but you're still getting cash flow from that deal. So guys, kind of just talk to that point, and either of you can go however you want to do it.
Yeah. So, and real quick, I know a lot of our returning investors probably know how this works, but I want to go over how our model's set up. It's the exact same for both of these deals,
Sure.
How investors are paid back, how they receive cash flow.
Yep.
This is the most simple way to do it. We have the most simple model on the market, I think, which is a big plus of investing with F Street. You understand why you're getting money now and what part of the distribution process, the waterfall process that you're in. So real quick, but we give a 7% preferred return to our investors on these deals, right? Yep. That means if you invest $100,000, that in year one, we owe you $7,000 of interest. It's technically not interest, but it acts in the same exact way as interest.
Yep.
If we were able to distribute more than $7,000, we use that cash, the excess, to start paying down your investment.
Yep. Your principal investment, the $100,000.
Yep, exactly. Yep. So we pay you back the $7,000 first, right? And then if we have $10,000 total to distribute, we'll take that extra $3,000 and we'll start paying back your initial principal invested.
Yep.
So the next year, when calculating your preferred return, it would be $97,000.
Yep.
Times the 7%, right?
Yep.
And that keeps going and going and going until your investment is completely paid back. It's like the same as a loan, the same as a mortgage,
Yep.
right? And then after the point of which you've been fully paid back on your investment, then the the cash flows, the distributions split between F Street and the investors.
Yep.
So it's extremely simple. If you have any more questions about it, please reach out.
And in this deal, in both these deals, guys, what is the split of cash flow after the investors have gotten all their principal?
50-50.
Yep. So it's 50-50. So all of the cash flow that comes into that building after you've received your money back, your initial principal plus all of your preferred return, we then split the cash flow between F Street and all the investors in the deal. 50% goes to F Street. 50% is then split between all the investors that are inside the deal. Now, tell people just how, the advantage of something like this, of getting your money back right away. Like, this is something you talk about it being one of the most simplest thesis in the market. Get people to understand like what else is out there or what other things are out there.
Go ahead.
It's our money tree concept. So if we're able to execute, call it the best case scenario, where in 2 to 3 years, we can pull out all of the equity dollars, which again, so if you invest $100,000 and let's say that gives you a hypothetical 2% ownership in the entity. Mm-hmm. Even if we give your $100,000 back, you still own that 2% of the entity that owns the asset. Yep. So you maintain your equity while having your principal back to you. And we call it planting money trees, because if we're able to execute on these value add strategies and refinance, avoid that taxable event, and put your $100,000 plus some back into your pocket. Yep. From there, we'll have more investment opportunities in 2 to 3 years, and then you can invest in those. Yep. So you have your 2% ownership in, call it entity one, and then 2 years down the line, you invest in that other one. Now you have 2 investments, and you compound this over. Let's say you make 2 real estate investments a year, 1 investment a quarter, so which would be 4 a year. Over time, if you're doing some stable deals that give you cash flow like Prairie du Chien, and some other ones that are a little bit more value add investment profile, and then you're continuing to plant these trees in 5 years, I mean, who knows where your portfolio could be, because you're maintaining ownership in a lot of these assets and entities and maintaining cash flows while increasing the total number of investments you have. That's really our thesis. We don't have a general fund model. Each deal is its own syndication and is its own entity that owns one asset. So you reach diversification by investing in multiple and investing in the ones that fit your risk profile and your investment goals.
Yeah. And at the end of the day, that is our whole goal with you as the investor, right? We want to build a super long-term relationship with you. We want you to understand and trust us and know that we as operators can get these deals done and pay you out each month. And that is our goal, to make sure that you stick with us for a long period of time, because as Brian was mentioning, we want you to plant those money trees. That's how you're going to grow your generational wealth. That's how you're going to grow your wealth in general. And as an investor, you want to be doing things that give you that, not just investing in one alternative investment, but kind of spreading your funds throughout all these different areas. And not just with us, but we want a portion with us, and we want you to be growing with us as we continue to do these deals. Guys, I want to just quickly talk about some terminology stuff. So we're mentioned in these deals, and investors, if you go to our website at fstreet.com and you look at these deals, you're going to see things like IRR, EM or equity multiplier. You mentioned waterfall. Let's give the investors some idea of what those mean and how they are targets that we're trying to hit, so that we can show you what these deals look like.
I'm sorry, I did not know there was going to be a pop quiz today. No, I'm just kidding. Fire away with any questions you have.
Yeah, I can start on that. The simple of the two, we broadcast equity multiple and IRR quite often, right? The simplest of the two is the equity multiple. It's easy to understand from the equity multiple how much cash we project that you make over the whole period of the investment, but it doesn't tell the whole story, right? So the equity multiple, if this deal has a 1.9 EM equity multiple, it just means if you invest $100,000, we think we're going to give you back $100,000 plus $90,000 more. That's where we get that 1.9 from. Equity multiple is simple. IRR is much more complicated, but I like it because I think it does paint the whole picture. So the IRR is telling investors, what percent do I have to discount my future cash flows each year to make my present value, today's value of this investment, $0.
Yep.
So essentially it's saying how much, if I receive $20,000 a year from now, what do I have to discount that by based on that year, the following year, all the way to the sale of the property where there's going to be that big cash flow.
Yep.
That's why if the sale of the property is 10 years from now, your IRR is probably going to be lower than if the sale of the property is 5 years from now, because it has to be discounted each and every single year going back.
Yep.
It's not the easiest to understand, and it's not the easiest to explain, as you've probably been able to tell from my explanation. But ask ChatGPT, it'll give you some really good elementary examples, but it is the best way to really understand how good is this investment.
Sure. It factors in the time value of money. And the big thing I like to point out is you really have to look at the equity multiple and the IRR side by side, because the longer you hold an investment and the more, quarterly or monthly cash flows you earn before that sale event, the higher your equity multiple is going to be, because it's nominal dollars in versus nominal dollars out. But as Lane mentioned, that time value of money with the IRR, all things equal, with a 5-year hold and a 10-year hold, the 5-year hold is going to be a lot higher of an IRR. But another thing I like to point out to investors is if you look at call it a 2-year investment with a 30% IRR, that's going to look really good. But if you look at a 10-year investment with call it a 14% IRR, it doesn't look as good, but you're going to make more nominal dollars over that 10 years. Mm-hmm. So when you're looking at that 2-year investment opportunity, you have to say, okay, to continue making money on a 10-year time frame, I have to then reinvest those into a new investment, which is going to have an inherent amount of risk. And then I have to reinvest again in another 2 years. So you can't just look at, the big IRR number and call it a day. You also do have to look at the time of the investment, because a 14% return on average over a 10-year period is great. I would sign up for that investment all day long. I would also sign up for a 30% IRR in 2 years, but then I have to, find another compelling investment after that 2 years to then reinvest, to then essentially reach that 10-year investment horizon that I'm comparing it to.
Correct me if I'm wrong.
You're wrong.
Can an investor, not yet. I might be though. I think I'm right though. Can an investor look at IRR as what they would make per year during the entire lifespan of the deal?
Kind of.
Okay.
Yes and no. Yeah. Yes and no.
Kind of, because if you have, what's the best way to explain this? You could have zero cash flow in year 3 and still have a 20% IRR. So in a way, it's averaged across time, but it's really taking into account how long the hold period is of the investment. So no, because if you have a 10-year hold and a 10% IRR, that doesn't mean you have an equity multiple of 2.
Yep.
Right? It's going to be different almost every single time because cash flows are not going to be the same every single year.
Sure.
But
yeah, I don't like doing that. I know we're talking industrial acquisitions here today, but especially like when you're talking about a development deal where you're not seeing cash flow for a year or two. And then if you start telling investors, hey, your average return is going to be 18, 19% over a 4 or 5 year hold, then it kind of just inherently lets them think, oh, those first 2 years I'm earning 18 to 19%.
Even though they're not getting anything.
And they're going to be let down, right?
Yeah,
so
which I would personally say is a misrepresentation.
And I shouldn't say they're not getting anything. They're getting their interest accrued. They're just not seeing those distributions hit their bank account, but it is owed to them at the end of the day.
That's why we find it very important in all of our media, if it's a roundtable or an investment packet, to show what the cash on cash is on an annual basis, right? Or we might show years 3, 5, 7, 9, because we want investors to see, okay, cash flow is going to be higher in year 3 than it is in year 7, because maybe we refinance somewhere in between and we're able to cash out investors, right? So the cash on cash.
Let's talk about cash on cash real quick. What does that even mean?
And I'm going to take that one step further. If we can compare the preferred return, which is 7%, or in some deals 8% with F Street, with the cash on cash, because this is a question I get all the time. So I'm going to pass that to you, Lane. I can answer it too, but I want to see your answer.
We'll tie this into waterfalls as well.
Yeah. Oh, yeah.
Right? So let's start with the broad term of cash on cash. You invest $100,000. You're a $100,000 investor. You should invest more if you want to, though. Not saying you have to stop at $100,000. But you're a $100,000 investor, and in year 1 of the deal, we distribute $9,000 to you. Mitch, what's your cash on cash?
9%.
Correct.
Bingo.
9%. Cash on cash is very rudimentary. It's just exactly what percentage of your investment did we distribute to you that year. Now, as you remember, we talked about preferred return earlier. And if your preferred return on this deal is 7%, which it is in Hot Springs and PDC, you'll be receiving $7,000 in preferred returns in that first year. Now,
$2,000 is going to go towards your principal.
$2,000 is getting paid down towards the principal, exactly. But it all goes in towards cash on cash. I know, Mitch, you can do the happy dance, the big beautiful happy dance, because you nailed that one. Yep.
Nailed it.
No, that's exactly right. And it's all just a function of distributions, cash flow paid back of your investment or on your investment, right? It's the preferred return or it's the repayment of your initial investment.
Cash on cash does not
it doesn't
take
sleep
into account. It does not sleep, and it does not take into account preferred return or return of capital. It's just, what are we giving you on an annualized basis for the investment that you made? And then, preferred return is essentially, we're going to call it that air quote interest on the money you invested that's still in the deal. So your cash on cash or your cash return is going to be made up with F Street of some type of preferred return and some element of return of capital. But a lot of investors do, especially if they're newer, they do get the preferred return and the cash on cash mixed up. Cash on cash is just, what do we actually project to distribute, regardless of preferred return or return of capital?
Now, I want to make one more point on this, which it shouldn't have to do with these deals at all, but because the cash on cash that we're projecting is higher than the preferred return, right? Our cash on cash out of the gates for these deals is 8 to 9% versus our 7% preferred return. If, in the instance, in like a lot of our new developments where we're not distributing cash flow out of the gate, your preferred return does not get paid, it does start to compound, right? It adds up. We don't just say, oh, we don't have any money for you right now. Sorry. That $7,000 of your preferred return that we didn't pay you in the first year, that adds on to year 2, right? Then we still have to pay that down and your current annualized preferred return prior to paying down any of your investment. So it shouldn't be in effect for either of these deals, but it is something important to know about our model that we do pay back preferred returns in arrears.
So I know that was a ton of information today. I hope whoever is watching this, whoever is looking at this recording, that you just know that this is a part of your due diligence process. I always love giving kudos out to anyone that does watch these or that does look at these recordings, because at the end of the day, you're responsible for your due diligence. You're responsible for your investments. You're responsible for your wealth. And I just really want to thank you guys for your time today. These two are are honestly, again, we get to work again next to each other every single day. The wealth of knowledge that these both young men have. I say young men because they are a lot younger than me, which is just crazy. But they have a lot of knowledge and they understand these deals very, very well. So if you do have any questions at any point in time, like something's just not clicking or going over your head, we are all available to be able to talk with you. You can reach me, Mitch at fstreet.com, Brian at fstreet.com, Lane at fstreet.com. We are available at any point in time. And again, just go to our website, go to fstreet.com, look at the deals, and any questions that you have, you can connect with us. Guys, I'll give you to the parting moments. Anything else you want to say before we get out of here?
Yeah, if you can't tell, we love talking real estate. We love talking the model, F Street, the structure, deals. We are deal junkies is kind of the term. So if you have any questions, you want to dive in, you want to get into the weeds, as he said, Mitch, Brian, Lane, all at F Street. Let's chat.
Are you Brian with an I or Brian with a Y?
It is I. That's a great indicator.
Brian.
What's your social security number?
Ooh, 1, 2, 3, 4, 5, 6, 7, 8, 9,
10.
No, I echo Brian's sentiment. We're here all day long, so give us a call or shoot us an email. We'll be happy to talk. We love talking about these deals. We are very transparent in all that we do and want to share our knowledge with our investors. It does us no good if our investors are only investing in one deal, right?
Yeah.
That's why we make a importance of paying people back as quickly as we can, and we want you to come back and we want you to become successful with us, right? So yeah, Mitch, I appreciate you having us on. It's been
thank you.
It's been a great episode.
Excellent. I appreciate you guys so much. Everyone, thank you so much for your time today, and we look forward to seeing you back again. Take care.